Welcome to the deep dive. Today, we're jumping into something pretty huge in the markets. Gold's incredible run in the first half of 2025.
It really has been something else.
Absolutely. I mean, it's been on a record pace, climbing, an astounding 26% in U.S. dollar terms?
Yeah, and that's just the dollar view.
Exactly. It wasn't just a U.S. thing. Gold hit double-digit returns across multiple currencies, made it one of the top-performing major assets out there. And get this, 26 new all-time highs, just in the first 6 months. And that's building on the 40 highs it hit back in 2024. Just wow.
A truly remarkable run, no doubt about it.
So this deep dive is really for you, our listener. We're going to unpack a recent mid-year outlook from the World Gold Council. It's our Gold Mid-Year Outlook 2025.
It's a really thorough piece.
It is. And the big question they're tackling, the one we'll explore, is basically, is gold heading downhill or for second wind?
The million-dollar question, or maybe the multi-trillion-dollar question, given the market size.
Right. So our mission here is to pull out the key nuggets of knowledge about why gold did what it did and, what might happen next. We want to help you understand the main factors driving things. Okay, let's dig in.
Sounds good. So the report, it really lays out this combination of factors behind that H1 performance. It wasn't just one thing.
Right.
You had a significantly weaker U.S. dollar. Actually, its worst start to a year since 1973.
Wow, since 73, that's significant.
Definitely. And that was combined with interest rates, yields, sort of staying in a range, not really tempting investors away from gold too much. Plus, clear signs that rate cuts were coming.
Okay.
And then, of course, the big one, heightened geopolitical tensions, some linked, directly or indirectly, to U.S. trade policy. It's contributing to what the report calls a new trade order.
Okay, new trade order. Can you unpack that a bit for us? What does that actually mean in practice? Is it just tariffs or more?
Well, it's sort of a mix. It's largely about increasing tariffs, yeah, but also geopolitical competition. Countries are focusing more on, national interests and making sure their supply chains are secure rather than just pure globalization.
So a more fragmented world, basically.
Exactly. More fragmented, less predictable. And that creates this sort of underlying anxiety in the markets. And it wasn't just these big macro trends either. We saw a huge surge in investment demand.
Ah, right. People actually buying gold.
Big time. Trading activity across OTC markets, that's over the counter, direct trades, plus exchanges, ETFs. It just skyrocketed.
Right.
Average daily gold trading volumes hit a record $329 billion. Billion in the first half.
$329 billion a day. That's staggering. That really underscores the level of uncertainty, doesn't it?
It absolutely does. And you see it reflected in gold ETFs, too. Global assets under management, AUM, for gold ETFs, up 41% to $383 billion.
Wow.
And total holdings, they rose by 397 tons. That's like $38 billion worth of gold. It brought total holdings up to 3,616 tons.
Which is a lot of physical gold.
A huge amount. Suggests serious institutional commitment. It's the highest month-end level since August 2022.
And it wasn't just investors, right? Central banks were still buying, too.
Yep. They kept up their robust buying. Maybe not quite at the absolute record levels we saw before, but still way, way above their average before 2022.
So it's really a diverse mix pushing gold higher. The World Gold Council uses this model, GRAM, right, to break down the drivers.
That's right. The gold return attribution model, it helps quantify things.
So for gold, 16% returned over the last 6 months within that bigger 26% move. How did GRAM break it down?
Okay, so about 4% came from risk and uncertainty. And interestingly, half of that was tied directly to the increase in the geopolitical risk index.
That makes sense.
Then 7% came from opportunity cost. And the bulk of that, about 6%, was linked specifically to the dollar getting weaker.
Right, making gold cheaper in other currencies.
Exactly. And finally, 5% was chalked up to momentum, mostly connected to those strong positive flows into gold ETFs we just talked about.
What's really insightful there is how clearly the data points to dollar weakness and, geopolitical risk as major catalysts. It's not just hype.
Precisely. It quantifies how much gold is acting as, well, a barometer of global anxiety. And a pretty effective one, it seems.
Okay, so understanding why gold surged gives us a solid footing. But like the World Gold Council asks, is it downhill or for a second wind? This is where it gets really interesting, looking at the potential paths ahead.
Yeah, they use this gold valuation framework looking across 3 sort of hypothetical macroeconomic scenarios.
Let's start with the first one, Scenario A, continued normalization. This is basically the consensus view, right? What does that look like?
Right. This is what most markets are kind of expecting. Global GDP sort of moves sideways, stays below trend. World inflation actually ticks up above 5% in the second half, mainly due to tariffs.
Okay.
US CPI inflation maybe hits 2.9%. Central banks are expected to be cautious, but start lowering interest rates by Q4. The Fed maybe cuts 50 basis points by year end.
And geopolitics.
Stays tense, especially US-China. Basically, things kind of stay as they are now.
Okay, so if that's the backdrop, what happens to gold?
In that scenario, the report suggests gold could stay range-bound, maybe close the year roughly 0% to 5% higher than current levels.
Which still means a big annual gain overall.
Oh yeah, you'd still be looking at a 25% to 30% annual return for 2025. Pretty respectable. The thinking is, technically, this could be a healthy pause in the bigger uptrend.
Right.
And falling rates, plus that ongoing uncertainty, should keep investors interested, through ETFs and OTC markets.
But there's a catch.
Well, the report notes that these high gold prices are likely to dampen consumer demand, think jewelry, and encourage more recycling. So that acts as a bit of a brake.
It raises a key question then, doesn't it? If gold already reflects all this expected news, what could make it break out higher?
That's exactly the question, which leads us nicely into the other scenarios.
Okay, so if scenario A is steady as she goes, scenario B, deteriorating conditions, sounds like the bull case. Rougher seas ahead.
Definitely rougher. This scenario imagines either a more severe stagflation, slow growth, high inflation, maybe driven by tariffs sticking around, consumers getting worried, or it could be an outright recession.
Oof.
Yeah, either way, you'd see a widespread flight to quality, people getting nervous.
Oh, how would that feel for, say, the average person invested in the markets?
It would feel pretty anxious, I imagine. Your stocks might be down, inflation's eating away at your savings, general economic gloom. That's when people tend to lose faith in paper assets and look for something tangible, like gold.
Makes sense.
And in that world, you'd likely see lower interest rates, a weaker dollar, partly because of worries about U.S. economic leadership.
And central banks might react too.
Big time. They could really speed up moving the reserves away from the dollar. The latest survey shows nearly three-quarters, 73%, expect lower U.S. dollar holdings in global reserves over the next 5 years.
So if those storm clouds gather, how high could gold go? You mentioned COMEX futures earlier.
Yeah.
What do those tell us about potential upside?
Okay, so COMEX net longs measure how many big players are betting on gold going up. Right now, they're around 600 tons. During past crises, they've been over 1,200 tons.
Ah, so there's room for more big money to come in.
Exactly. Same with ETFs. Holdings are high, 3,616 tons, but still below the 2020 peak of 3,925 tons. And inflows in the first half were less than 400 tons, compared to 700 or even 1,100 tons in previous bull runs.
Meaning
Meaning there's still, quote, meaningful room for further accumulation. If things really deteriorate, the report suggests gold could rise another 10% to 15% in the second half. That would put it close to 40% up for the year.
Wow. Okay, that's the bullish picture. What about the flip side? Scenario C, risk resolution, the bear case. The report calls this unlikely, right? Why so unlikely?
Well, it's deemed unlikely because it requires essentially a sustainable fix to all these geopolitical and geoeconomic conflicts. Think trade wars ending, supply chain issues resolved smoothly.
It seems like a tall order right now.
A very tall order. It would need major policy shifts and de-escalation that just don't seem probable in the current climate. But hypothetically, if it happened,
What would that look like?
you'd see better global growth prospects, maybe rising U.S. Treasury yields, making bonds more attractive, a stronger dollar, and inflation stabilizing nicely.
And gold's reaction?
It could pull back. The report estimates maybe 12% to 17% in the second half. You'd still likely finish the year with positive returns, maybe low double digits, possibly even single digits.
And that pullback would basically be giving back the risk premium.
Exactly. It reflects the unwinding of that extra value gold gained from all the trade tensions and uncertainty in the first half.
What would specifically drive that downside? And are there any floors for the price?
The drivers would be less risk overall and higher opportunity cost, meaning rising yields and a stronger dollar make holding gold less appealing. That would likely trigger ETF outflows, less investment demand generally. Central banks might slow their buying too if treasuries look good again.
Okay. Any support levels mentioned?
Yeah, the report points to US $3,000 an ounce as a potential natural support level, like a point where opportunistic buyers might step in.
Bargain hunters.
Kind of. And also, if prices fell lower, you'd likely see more consumer buying jewelry again and less recycling, which would help limit how far it could fall. Importantly, the report notes that the usual suspects for big gold pullbacks, like major interest rate hikes from here or a totally saturated investment market, they just don't seem to be present right now.
Okay, so let's try and wrap this up. It's been a fascinating deep dive. Gold had this exceptionally strong start to 2025, up 26%, driven by a weaker dollar, geopolitical risk, lots of investor demand, central banks still buying.
That's the picture, and the path forward looks complex. It's all tied up with trade tensions, inflation, what central banks do next with rates.
Right. The consensus scenario A points to a relatively steady finish, maybe some moderate upside left.
But if things get rockier, scenario B, stagflation or recession gold, could really take off again, potentially hitting almost 40% gains for the year.
And the opposite, scenario C, widespread conflict resolution, seems unlikely but would definitely hit the price.
Yeah, that's the bear case involving a pullback.
So ultimately, the big message from the World Gold Council seems to be that forecasting the global economy is, well, hard,
Always is.
right? But gold, because of its specific fundamentals reacting to risk, currency moves, rates, it remains pretty well positioned to play a role for investors, both tactically short-term and strategically long-term in this uncertain world.
That sums it up well. It has multiple drivers, which gives it resilience across different potential outcomes.
Which really leaves an important question for you, the listener, doesn't it? How might you interpret these different scenarios? And what does this whole picture tell you about the enduring role of a safe haven asset like gold in, well, an increasingly unpredictable world?